Hi everyone, welcome to this session for founders preparing to raise seed and Series A investment. My name is Stefan Knight and I'm a startup account manager at AWS. I've been involved in tech startups since the mid-90s. I've also got a lot of experience in raising seed capital and venture capital in the US, Australia, and the UK. My experience in startups spans IPOs, acquisitions, and even going bust, the true array of startup experiences.
Hi, I'm Kelsey Dory. I'm a biz dev manager on the AWS startup team. I recently joined AWS after relocating here from the US. I've been involved in startups since graduating from uni in 2003 and have experienced raising capital, including founding my own startup called Vow to be Chic. So, who is today's session for? Let's look. This session is for startup founders who have no to limited experience in raising investment capital. We'll cover seed fundraising and raising what's called a Series A, the first funding round with venture capital involved. We'll discuss tips, resources, and an approach to prepare you to go out and raise funding on your own. From this, you'll gain a perspective that fundraising events are pivotal moments in a startup's history that can set the company up for success or failure. Next, let's look at the agenda for today's session. So today, we're going to use the metaphor of taking a journey, a road trip, to the destination, which is raising a round of capital. We'll start by setting the scene of why this is important to every founder. Then we'll plan the journey and prepare to set out on the road. On the road, we'll talk about the people you'll meet, such as investors, and prepare you to get inside their minds so you can be effective. Finally, we'll leave you with a call to action and a set of resources to take away and begin your preparation. Let's go. Over to you, Stefan.
Okay, let's first set the scene and talk about why this topic is relevant to startup founders. Few founders have a finance background or have worked in venture capital. You might be tempted to delegate fundraising to an advisor or agent, but both seed and venture investors want to know the founder and gauge their ability to execute. If you're unprepared and present the business poorly, the likely outcome is a poor valuation, settling for terms that stunt your growth and invariably set the company on a poor trajectory for the future. You may choose to disregard our cautionary tale, but then it's down to luck, and we all know that relying on luck isn't a very good strategy. So how can AWS help? Well, we have a specific program called Activate for Startups. Sign up for Activate and we'll start the process to assist you commercially and technically as you build your business. We've built a team of ex-founders and startup operators to work with our startup customers to help them. Our team has raised many billions of dollars in venture capital from top-tier VCs and taken companies through acquisition and IPO. You can get access to our team via the AWS Startup Mentoring Program and the program for startups called Activate. We've worked with thousands of startups and hundreds of unicorns globally and have powerful insights collected along the way that you can learn from. In fact, unicorns build on AWS. Over the last 14 years, the biggest tech businesses, including Airbnb, Canva, Atlassian, and others, have built their businesses from scratch on AWS. We've walked hand in hand with thousands of startups as they go through the journey, and it's that experience of having seen the successes and the failures that puts us in a great spot to design startup programs to help new founders like you. We hope you're building the next companies to join this slide. Kelsey, can you share an example of one such company?
Sure, happy to. Let's look at a good and a bad example that Stefan and I have personally witnessed in our startup journeys. In order to share more details, we're going to withhold company names. So a positive example comes from a US female founder. She went out to raise and really thought big and dreamed big and had a big vision for her startup that she shared, right? So she didn't think of what her company was today, she thought of what it could be in the future, many years down the line. Then she learned to get in the investor's mindset, right? They have a certain fund size and they can make X number of investments in startups. They need at least one of those, ideally more, to be massive successes worth billions of dollars and exiting for billions of dollars. So she laid out for the investors how her company could be worth billions and could exit and therefore make them a lot of money and a great return on their capital. Also, have confidence. I know there's imposter syndrome and we're all going to be a first-time founder at some point, but you've got to have confidence, right? You know your product, you know your market, you've done your research, and you're going out to get investment in your company. Stefan, can you share a cautionary tale, please?
A few years back, before joining AWS, I ran Telstra's Muru-D Startup Accelerator program in Sydney. We had 10 companies join the program, and I spent the first 3 months coaching the companies not to accept early-stage funding on poor terms that would have limited the ability of the companies to make critical business decisions that protected the investor to the detriment of the founder and would have made it very difficult to raise follow-on capital. 8 of the companies are still viable today and have gone on to raise professional venture capital and position for successful growth. This is a great diagram that shows the different fundraising rounds and players. I'll talk us through the various rounds, and Kelsey will talk about the different types of investors at each stage. A pre-seed round is usually the first capital the company takes in. The total amount is usually a few $100,000, and you want to make it as easy as possible and avoid high legal expenses. Seed rounds follow as the business grows. The idea is not to raise too much money early because the value of the company is low and the percentage of equity you'll sell in the company is greater than later on when you've proven out the business model. Ideally, you will not sell more than 20 to 30% in early fundraising. A Series A round is the first round of capital involving professional investors. Series B, C, D, etc. follow. A good rule of thumb with respect to whether a company is ready to raise a Series A is whether the annual run rate revenue is $1 million or more. Customer traction is typically the most important factor when raising capital from professional investors.
Thanks, Stefan. An angel investor is typically a high net worth individual who invests $50K or more early on in a startup's life. Later, venture capitalists are professionals who work for venture funds. Venture funds typically raise $50 to $500 million in a single investment fund with a 10-year time horizon to make investments and deliver returns for their limited partners, who may be corporates, individuals, or even government entities. Private equity funds generally invest in later-stage private companies. As a startup progresses and has material revenue and a stable business model, venture debt and traditional debt are other ways in which a startup can raise capital. So hopefully we didn't overwhelm you with too many terms and information, but don't forget, it's new to every first-time founder. Okay, Stefan, we've got the lingo down. What's next?
Okay, now let's prepare for the journey. You wouldn't take a road trip without first investigating what the best route would be and where you might like to stop to see the sights along the way. Similarly, you shouldn't run out and start meeting investors without developing your fundraising skills and planning out a strategy before taking your first meeting. A good place to start is building your network of other founders, especially the ones that have raised investment capital. Founders that have done it are often very generous with their time and advice because they appreciate how hard it is to do well. Do some reading. We'll suggest some resources for you at the end of the presentation. Developing skills often requires research, and fundraising is no different. You'll come to learn that not all venture firms invest in all categories of startups. Some may specialize in healthcare, agriculture, software. Many U.S. investors don't invest internationally. Some firms focus on Series A, while others only invest in later rounds. It's also not a sure thing that an investor that has invested in a company similar to yours would be interested because they might see that as a conflict of interest. So develop a list of prospective venture funds you'd like to pitch to. Plan on spending significant time preparing your pitch and practicing your pitch. We suggest you test drive your pitch with founders that have raised capital successfully. Now let's get out on the road. Time to pitch to investors. Over to you, Kelsey.
Now let's talk about meeting investors and pitching to them. There's a method for the investor pitch. There's a link at the end of the presentation to the Y Combinator pitch template. Follow this or any of the similar templates that direct you to provide specific information that every investor wants to know. Give the investor this information. It's what they want and need in order to make their investment decisions. Less is more. Stick to the facts that they care about. Keep in mind, give investors the information and ideally a 1 to 2 liner on your company so that they can then go and pitch your company correctly to the rest of their team. Help them help you. Also, proactively answer FAQs in your presentation, preferably with data. So if you're asked a question commonly, build it into your pitch. You're also going to have some hard questions. Answer those early on so that the audience can focus on the rest of your pitch and they aren't thinking about that one hard question the entire time, or worse, writing you off early on in the pitch. Here's a quote that I love that's funny but true. Ask for money, get advice. Ask for advice, get money twice. Pitbull. It's a very true statement though, right? So oftentimes investors are flattered, as anyone would be, when you go and ask for their advice. So go out, ask a lot of potential investors for their advice, build a relationship, and then you'll figure out whose advice you like, build that into your company, and they'll be probably more inclined to give you funding later on. Then when you meet an investor, you're under the microscope. It's like dating a lot. Take time and really understand their mindset. You can look up the power law curve of VC, which we've alluded to earlier, but that's an interesting thing to look up. But what are they looking for in new deals? What sectors are they looking at? What stage? What investment rounds? Really get in their head and pitch to what they're looking for. But keep in mind, it's like a long-term marriage, so you want to find a great partner for you who's going to be there through thick and thin. And investors need to please their investors, right? So their investors are limited partners, or LPs, and they want big returns. So they're looking for founders with big visions who can execute. And unfortunately, most startups are going to fail. So they need massive multi-billion-dollar exits from a few startups. So you should explain why you're worth one of their few bets at being the next multi-billion-dollar startup. Also, ask for genuine feedback. The worst thing you can do is leave a meeting with an investor and not have heard their real opinion about your business. Investors see thousands or more pitches a year, and they're always looking for great talent in terms of founders. They may shy away from giving you critical feedback, so ask for it. It could be the best advice that you'll never get if you don't push them to be real with you. Finally, tell them how you're going to execute and get it done. Go in with a few accomplishments you know you'll deliver in 30 days, 60 days, 90 days. That way, you're setting a scene for a follow-up meeting and telling them you'll be coming back, hopefully, via email or in person. But then you can come back and tell them what you achieved. And hopefully you've achieved more than what you put on your promised roadmap, right? But therefore, you're setting yourself up as a founder who knows their business and executes and is reliable. After we pitch, the goal is to get a term sheet, or a few of them. So Stefan, will you take us through term sheets?
We could spend many hours talking about term sheets. Term sheets lay out the key terms of the investment. Either the investor or the startup can author the term sheet. The term sheet sets the valuation and any investor conditions that come along with the money. Don't delegate understanding the term sheet to your lawyer. Study the terms and think about their impact. Watch out for some classic bad terms, or as Bill Gurley, the famous venture capitalist, calls them, dirty terms. I like to ask for a term sheet from an investor that's interested so I can see how they operate before I open up and tell them everything about the company during due diligence. Bad terms like guaranteed IPO terms, ratchets that protect the investor at the expense of the founder, and control over future fundraising are all terms to avoid. Okay, that's a high-level view of term sheets. Kelsey, what's next?
Okay, now you've built your deck, pitched a bunch of investors, and hopefully received a coveted term sheet, and you've understood the terms well enough to negotiate those terms. At that point, you'll close your round and get back to the real work of building your company and executing on your big vision. So what's next? It's time for you to prepare for your journey. The first step is to do your research and learn from others who have been there and done that. These are some of my and Stefan's favorite resources for you to check out. First, read books and websites dedicated to startup fundraising. One of our favorite books on raising capital is written by an entrepreneur who became a VC and co-founded Techstars. It's called Venture Deals by Brad Feld. Next, develop a network of founders who have raised capital and those who are going through the process with you. Search out both good and bad case studies and learn from other founders' mistakes. Then you're going to build your deck. On this slide are some great resources for you to study how to build an effective pitch deck. Pitch the pitch to other founders who have raised capital. Watch pitches. There's pitching events and example videos on YouTube, Techstars, etc. See for yourself what good and bad pitches look like. Also, videotape yourself pitching your slides and be self-critical. Become an expert on your story. AWS is here to help. The first thing you can do if you haven't already is to join the Activate program for startups. You'll be eligible for credits to offset the cost of building your company. And as you progress and grow, you can become eligible for additional credits and help from our startup team. Our solution architects, who are like CTOs, have startup backgrounds and can provide advice on which services and architectures can get you up and running while ensuring you can scale, be reliable, and secure. For later stage startups who have established customer traction, we can coach you on fundraising. Also, many accelerators, incubators, and venture capital firms are partners in our AWS Activate program, so joining one of those can be a great way to access our team and additional AWS benefits. On behalf of Stefan and myself, thank you so much for joining. Good luck on your startup journey, and we'll be cheering for you from the sidelines. If you enjoyed our session, please complete the survey, and thanks for watching.